Greetings and hello. My name is Zainab Abdullahi Umar, and I'll be discussing a case study analysis of Saudi Aramco and corporate venture capital. This is assignment for the Venture Capital and Private Equity course by Dr. Michael Norbert of the International School of Management. My discussion will cover a brief history of the Kingdom of Saudi Arabia, Saudi Aramco at a glance, the historical milestones, operational autonomy of Saudi Aramco, success stories, strategic advantages, export destinations, the global crude oil reserves, organizational culture, Saudi Arabia national statistics as at 2011, the national challenges it faced as at that time, corporate venture capital as a whole, and its role in the energy industry. Then specifically, I'll focus on Saudi Aramco corporate venture capital and how it is managed internally. I'll also discuss the relationship between a CVC and a startup, as well as the learning journey that Saudi Aramco corporate venture capital has gone through and how it takes on investment decisions. Saudi Aramco also had a lot of shifting strategies due to the oil downturn. And then finally, I'll conclude with a SWOT analysis. To start with, the Kingdom of Saudi Arabia is located in the Arabian Peninsula of Western Asia. It has a desert landmass of 830,000 square miles, and it is the Islamic epicenter. It used to be one of the poorest Middle Eastern countries prior to its oil discovery. Saudi Aramco at a glance. Saudi Aramco is headquartered in Dhahran, Saudi Arabia. It is the national oil company and it is involved in oil exploration from crude oil production to refining, distribution, and shipping. It has a lot of products marketed, such as the natural gas, crude oil, petroleum refined products, and chemicals. Saudi Aramco has been through historical milestones, starting from 1933, in which Saudi Arabian government engaged the Standard Oil of California, also known as SoCal, to explore oil for exchange of $50,000 in gold. In 1938, the first oil field was discovered in Saudi Arabia, which is called Dammam number 7, with a large commercial capacity. In 1960, the Organization for Oil Exporting Countries was established, OPEC, in response to price cuts by Western oil companies, and therefore it had the main goal of regulating oil prices worldwide. In 1988, Saudi Aramco, the Kingdom of Saudi Arabia, gained full ownership of SoCal, making it the national oil company. In 2003, the Saudi Aramco company established a new business development division to create value through joint development projects for the kingdom and the company. In 2013, Saudi Aramco launched a $500 million corporate venture capital fund, and in 2014, Saudi Aramco managed 261 billion barrels of oil reserves, as well as 294 trillion cubic feet of gas reserves. Saudi Aramco has an operational autonomy. This is because the king, as at that time, ordered the following. Firstly, the Supreme Council for Petroleum and Mineral Affairs is to oversee the Saudi Aramco. There should be no government interference in the day-to-day management of the national oil company. All communication must be via the ministry. Decisions regarding the petroleum levels are the responsibility of the government, and Saudi Aramco is self-regulatory. Saudi Aramco has been through a success story. Starting from 2014, it produced over 3.5 billion barrels per year, which accounted for 13.3% of global crude oil production. The company issued royalties and dividends to the government as a converted earned profits. It maintained strong corporate culture and structure. Saudi Aramco efficiently managed both upstream, which is the exploration and production of oil, as well as the downstream, which is the refinery and distribution activities. Saudi Aramco has a lot of strategic advantage, one of which is that its refineries were strategically positioned closer to the consumer markets, which is farther away from the production site. This is because the transportation of raw crude oil was cheaper, unlike transporting refined oil, which required costly special pipelines. Another strategic advantage is the maintenance of in-border oil fields for the purpose of future discoveries of oil reserves. It also invested in multiple joint ventures in exchange for equity in developed nations' refining assets. Saudi Aramco aims to achieve a world-class value chain downstream business to service different locations. Saudi Aramco has numerous export destinations, but the major market share, about 68%, is in Asia, followed by 90% in Europe, 8% in the United States, and 5% for the others. It also planned to export oil to Africa, and as of today, Saudi Aramco is the largest oil supplier to China. The global crude oil reserves. Saudi Aramco is the largest national oil company in the world, followed by Venezuela. The organizational culture in Saudi Aramco has contributed immensely to its success story. This is because 87% of Aramco employees are Saudi nationals. It has subsidiaries with over 100,000 contractors. Gender equality in the workplace, timely promotion exercises, and a comprehensive pension and retirement package for its employees. Perks exist, such as the appreciation token of a gold wristwatch, which is given as a gift to employees when they put in 30 years of service. Saudi Aramco also offers employee development sponsorship up to the doctorate level. Saudi Arabia's national statistics as at 2011. Saudi ranked 19th largest in the world economy, and it controlled 1/5 of the global oil reserves. 90% of revenues were generated from crude oil export. There was a growing population. From 2011, Saudi had 28 million people, and by 2019, Saudi had 34.3 million people. And this high growth presented with some challenges, which I shall discuss soon. 2/3 of the population are young adults aged below 30 years, and foreigners living in the country, residents there, are 20% of the total population. So there were a lot of national challenges faced due to the high growth rate. These include increased youth unemployment, inadequate infrastructure, low price domestic gas and petroleum products, high energy consumption rate. So the government provided a solution to source an alternative energy for its citizens. So to discuss corporate venture capital, according to Fuller et al. 2016, corporate venture capitals are cyclical in nature as evidenced by history. The cycle begins with a high enthusiasm, then investment implementation, followed by obstacles and abrupt termination. Prior to the oil crisis of 1970, 25% of Fortune 500 companies engaged in independent CVC investments, known as the conglomerate era. A second wave of CVC investment occurred in the 1980s during the Silicon Valley era, while a third wave emerged in 1990s during the dot-com bubble bust era. As with previous crises, the unicorn era emerged with 15% of investment deals being CVC inspired. The energy industry witnessed CVC arms established within corporations. CVC played a major role in the energy industry. For example, major oil companies like ExxonMobil, Chevron, Total SA, Statoil, and Shell launched corporate venture capital funds in 2011. In 1997, Shell offered $1 billion investment fund, which was externally managed by a company known as Kenda Capital. In 1998, Chevron offered a $250 million fund to a portfolio of 30 different oil field service companies, and it was managed in-house. In 2008, Total Energy Venture Fund offered tens of millions of dollars to oil technology companies focusing on water use, and this was also managed internally. The CVC funds are designed to invest in startups with cutting-edge innovations in oil technology to augment the existing research and development departments in upstream and downstream operations. They all compete with varying organizational models for the future of oil breakthrough and technology. CVC investment in the energy industry is highly capital intensive, so corporations tend to invest in fewer companies but for a longer duration. unlike corporate venture capitals in other industries, which are less capital intensive but invest in more startups for a relatively shorter period. Saudi Aramco's corporate venture capital investment had a set of goals, one of which was to efficiently increase production of oil and gas in downstream refining operations. Also, it aimed at optimizing resources by increasing hydrocarbon reserves as well as oil recovery from 50% to 70%. It also aimed to utilize breakthrough technology in everyday operations and planned on a positive investment returns in 5 years. It had effective funding cycles and a good exit strategy. Having an internally managed corporate venture fund has its own advantages and disadvantages in terms of Saudi Aramco. The advantages include this has single source of funds, alignment of organizational and CVC strategy, research and development as well as corporate venture capital complement each other, and startups have access to tangible assets such as the distribution channels and intangible assets such as the technological know-how and knowledge or experience of the corporate venture capital. The disadvantages include the CVC arm is operated like a department, not a limited partnership, and the remuneration or benefits to serve is capped to be in line with the organizational compensation package. This poses a risk of losing talented employees to lucrative independent CVC, which can deter early stage companies from receiving corporate venture funds. The CVC and startup has a very unique relationship, which has its own benefits and risks. For example, one of the benefits include the CVC offers managerial expertise, access to distribution channels, and research and development knowledge, while the startup offers access to patented technology. On the other hand, the risks include potential management control, deterrence of third-party corporate investors, discouragement of potential strategic buyers, as well as intent to invest could be strategically to deny other corporate venture capitalists an opportunity. Saudi Aramco established a new business division in 2003, which played a crucial role in the expansion of downstream activities. It attained 15% of a Japanese petrochemical company and participated in large-scale refining activities on Sumitomo Petrochemical Complex in 2005. The new business division proposed a corporate venture capital fund to keep it active and towards value creation. In 2006, a $50 million corporate venture capital funds to funds creation proposal was denied as it was deemed too early in the life cycle of this national oil company. The idea was revisited years later and accepted to fast-track technological development in downstream operations. Recruitment of experienced and talented corporate venture personnel. Engagement of global consulting firm to ascertain Aramco's CVC potential. Saudi Aramco's team embarked on a learning trip to Europe and United States to study successful CVCs like the BP or Shell. Initially, before its learning journey, Saudi Aramco team planned on allocating 50% of its funds to upstream, 25% to downstream, and 25% to renewables. And then it deliberated over whether having a funds of funds kind of management, a co-managed fund, or an internally managed fund. After its learning journey, they learned that upstream offered higher potential for investment returns, and they decided to make sure that they diversify their portfolio as well as optimally use internally managed funds with direct investments so as to broaden Aramco expertise and build networks. The proposal for the CVC fund in Saudi Aramco offered a $500 million global investment fund and targeted companies with cutting-edge technology in either the early stage or the late stage. It planned on starting with the upstream and then later expanding to the downstream renewable technology, which should be favorable to the Saudi market. And the geographical location for the proposed fund investments had Europe and United States with plans to expand to Asia. The decade-size financing was between $5 million to $10 million for 2 to 3 rounds, with flexibility of up to $30 million per company, and the ownership was 5% to 35% equity stake. It also planned on a flexible holding period and will act as a natural lead syndicate, with the flexibility of being a co-lead or a follower. Saudi Aramco planned on having passive control of a startup, but with active engagement in business development. The fund management will be based in the home country, while the deal sourcing will be in Europe and United States. So for the fund management in the home country, it was mostly manned by the nationals, while expatriates were recruited for the deal sourcing in Europe and United States. The proposal also had an investment committee that makes investment final decisions. The CVC team maintained strategic alignment between Aramco and entrepreneurs. For example, if Saudi Aramco wants to make an investment decision, the first thing that happens is the identification of a potential investment, followed by a proposal presented by the entrepreneurs or the startup to the deal team. The deal team then goes ahead to observe and examine the proposal and see if it passes the financial threshold test. If the proposal passes this by showing a positive internal rate of return, then this proposal is passed on to the investment committee for final decision. If the investment committee approves this proposal, then it offers strategic sponsor support, and if it doesn't, the whole process is terminated. There have been a lot of happenings in the global oil market, and Saudi Aramco has had cause to adjust its strategy to leverage on the oil market downturn, focusing on downstream activities such as commercial sale of oil, which has proven valuable in times of oil crisis. The establishment of the Jazan refinery by the Saudi government to domestically increase refining capacity from 2.9 million barrels per day to 3.3 million barrels in 2020. This new Jazan refinery will be the center point of the Jazan economic city that will provide competitive advantage worth investor attraction in the region. It also planned on portfolio diversification of its petrochemicals in the energy industry. A SWOT analysis is a matrix that shows a company's strengths, weaknesses, opportunities, and threats. The upper side of the matrix has the strength, which is the internal resource that produces a favorable impact, while the weaknesses is the internal resource that generates an adverse effect. The lower quadrant of the matrix shows the external factors that create favorable impact on the company, known as the opportunities, while the external factors that create adverse effects are known as threats. These external factors could be in the form of political, economic, social, technological, or legal factors. The main aim is to increase and reinforce the strengths, overcome the weaknesses, take advantage of the opportunities, and minimize the threats. In the case of Saudi Aramco, some of its threats are flexibility and capacity to supply the different grades of crude oil to a wide customer base, global partnerships such as joint venture refinings with Japan, for example, low-cost oil and gas exploration, motivated employees, good strong relations with the Saudi government, global largest oil reserves, autonomous and self-regulatory as far as corporate venture capital development. Its weaknesses, on the other hand, however, is that the Saudi government is a mono-product economy that is dependent on oil exportation, and it has a narrow downstream capacity. Looking at the external environment, some of the opportunities Saudi Aramco could take advantage include the good market demand for oil, government-backed investment capital, high crude oil price, leverage on the OPEC policies to suit it, and its membership to the World Trade Organization. There also exist threats such as the political instability that made it difficult to expand its supply chain in the MENA region, oil price volatility which happens from time to time, cyber attack in 2018 to sabotage its production, as well as a drone attack that occurred in 2019. There was also a high domestic oil and gas demand. According to the New York Times in 2018, a cyber attack was launched on a petrochemical plant in Saudi Arabia. The attack was not designed to simply destroy data or shut down the plant. Investigators believe that it was meant to sabotage the firm's operations and trigger an explosion. Some energy experts believed it was an attempt to complicate Crown Prince Mohammed bin Salman's plans to encourage foreign and domestic private investment, to diversify the Saudi economy and produce jobs for the country's growing youth population. State-owned national oil companies control majority of the world's hydrocarbon resources endowments, as well as many of the major oil and gas infrastructural systems. Among the top 20 oil-producing companies in the world, 14 of them are national oil companies, which some of them are newly privatized. Kobayashi in his article 2007 states that many of the Western oil companies achieve a dramatically higher return on capital compared to national oil companies of similar size and operations. In conclusion, given the SWOT analysis, it is evident that Saudi Aramco is focused towards a continued global oil and gas supply. It continues to strengthen its strategic objectives through corporate venture capital and portfolio diversification. It uses cutting-edge technology for efficient production. There is the absence of government operational interference, and it has a resilient global joint partnership. It has strong presence in the European, United States, and Asian markets. It has an innovative organizational culture as well as a proactive strategic fit towards market dynamics. Thank you.